Good morning, everybody. This is Mark. We're back here for the morning call. It is Wednesday. So a week before Thanksgiving, fiscal cliff is in the picture. Market obviously is moving itself lower. It's correcting itself. It's in bear territory. The question is, what's the next step and what's happening? I know from a trading point of view, it's a very thin, whippy market with not a whole lot of movement in the sense of not a whole lot of consistent follow-through. Certainly from the long side. From the short side, you're certainly getting a little bit more. Every rally is sold up to key moving averages or key resistance, and I think that stays intact until it doesn't. So there's two rules of thumb I'm looking at in this tape. I think we need more digestion, which means we probably are in this type of mode. The only caveat is that it's options expiration and something could change going into Friday's action. But I could see more basing for the next week or two, certainly into Thanksgiving, and then we'll have to see what happens after that, or if some resolution comes to the fiscal cliff. Probably not. From a technical point of view, let's have the spider chart up here right now. It's waffling between above and below the 200-day every single day, intraday, and that's where we're at. That's hence the reason why I think a lot of people are having a difficult time finding a direction or really having some conviction, whether it's even for the short side or for the long side, because we had a nice rally right off the bat yesterday, probably almost a 100-point rally in the market overall, yet we couldn't hold it, and at the end of the day, we went right back to down 20, 30 for the day. Again, we're up this morning. Is it going to last? The previous few days tells me probably not. Technically, I want to see something change. I want to see something different. So look what we have here, guys. Spiders. This, I think, stays intact. So anywhere with 137.50, I think, still is a buyable opportunity. 138.50, 139, probably a shortable opportunity, or minimum selling some profits. Until it breaks out one way or another, that's the range we're in, and that's the range you have to respect. And you can back it up with the hourly chart that I have up. 139, 139.20 might be the high end. 137 roughly is the low end. Same thing we're looking at on the Qs and the IWMs. They are a little weaker, i.e. Apple, Google, some of the high beta stocks, certainly showing some weakness. Microsoft yesterday, with a key designer, key developer leaving, that had put some pressure on the Qs. Maybe there's some support at 62, but right now, 62 would be certainly the low end, which would be a new low. 64.50 the high end. Chart-wise, technical-wise, there's not a whole lot of leadership. That's why we're having issues, really picking a direction. Certainly if you're trying to buy. But from the short side, it's whippy. Let's start off with our favorite, Apple. It cannot find, it's either doing one or two things. Either to the bear flagging, or it's trying to find a little bit of a base and a little bit of a low put in to try to regain some composure. Not sure yet. Certainly over 555 will be that trigger on the long side, which ideally should, it's above the 8-day moving average, which would make a move, a significant move, I think, to the 575, 580 range. If that happens, we'll have to wait and see. In between that, and then on the low end, you have 520, 535-ish. So right now, we are in a 20-point range on Apple. So if you're buying it right at 540, or even 547, 546, which quite frankly was the yesterday trade for a little while, very difficult range, very difficult to have conviction, and it just means you got to be a little bit smaller and really key on prices because it is thin out there. Same type of action on Google, a little bit less lack of interest. It has been now below its 8-day moving average for a period of time, and that holds. So the key is if it can maybe regain some composure above 670, possibly it's a trade to the long side. Until that point, it's a short into the 8-day moving average every single time, and that continues to remain intact. Amazon, another high beta, much of the same. It's trading below its 8-day moving average, cannot get any composure. It doesn't look like it's going to get composure anytime soon. It just needs more time. Let's go to the banks for a second. Banks were showing some leadership. Two rules of thumb. It isn't still the top third of its trading range on Goldman Sachs, which I do like from a trading perspective. 112, 115 possibly is a buying range. But every time it gets up to the high end of the range, 125, it's getting some resistance. So this is the range it's living in right now. to me, not necessarily bearish, not necessarily bullish. Respect the prices. 112, probably looking to buy or take a dip into Goldman. 120 to 122, probably looking to sell. Understanding that above 125, might be a little bit more of an aggressive long, but the tape has to change. That is leading the banks. JP Morgan now is below some key moving averages, the 8 and 21. Don't love it. Don't see a whole lot. One of the industries we were looking at, and really, quite frankly, it's been the industry all year long that's been leading, and one of the strong industries is the home builders. They have now technically are under pressure, and I think you're seeing a little bit bigger picture here. I think actually rallies might be sold at this point in time. The trend changed, I believe, mid last week, and we'll have to wait and see. I have Toll Brothers up. You can just see it's now trading below the 8 and 21-day moving average, and that is a little bit significant. It is also trading below a 50-day moving average, and you can look at the XHB, which is obviously the overall index. You can see how the 8 and 21 are beginning to cross. That is a bearish signal. Understanding it's the strongest industry, and it has been the strongest industry, so it's not going to be the easy down move I think everybody wants. It's not going to be the flush. A lot of people are still long, but respect the fact that if it begins to really stay below the XHB, stays below 25, you probably can get downside action, possibly to 2350, which again would mean some of the home builders take a nice little hiccup. But that is okay. That's respected. But it seems like something has changed. So if you're just buying blindly on these pullbacks, I think you got to really look at the technicals to back up some of the ideas. Oils, commodities. Again, yesterday was one of those days. Tried to find some support at least early on. Couldn't hold up. That just means lots of selling is coming in late in the day. That's the pattern. Stick with it. One stock I'm looking at, Exxon, touched the 200-day for the first time. Going back to late July. I do like when a stock comes down to its 200-day for the first time. Usually it tries to find some sort of bounce, which the bounce at this point in time, if it's going to show any sort of strength, will be to around 88, 89. That'll probably be a little resistance, and it'll probably be bear flagging. So Exxon is on my radar this morning as an actionary trade for us to look at. But across the board, I can go to, APC not doing anything. Apache looking bearish to me. Schlumberger, not great, hanging at the lower end of its range over the last few weeks. Could get back down to 65. Nothing too exciting. This morning, we had a warning from MOS. Another down move. It's been trading. It's been lagging out of the ags. POT and MOS are the two laggards. AGU and CF were really the two leaders. But MOS coming out warning probably will put some pressure on the other stocks. I know POT is up a little bit this morning. Not sure exactly why, but not seeing anything great in the ag sector. We know AGU came out with earnings last week and has obviously held that downturn. So it looks like more pressure is on the ags. That's where we're at right now, guys. The one strange factor, and not necessarily the VIX really isn't moving up, which is really makes me question, but the VXX, if it actually every move up or down, it seems like it heads down. So a move below 3250. The VIX, obviously it's priced to zero no matter what, but it's something that it's a vehicle for us to trade again, obviously once they split it. So it's something that I keep on the radar. Talk about the bonds for 2 seconds. A lot of people are in it. Big money's in it, certainly. It has moved up in the ranks. I don't think there's a whole lot of stuff to talk about from the trading perspective. Just respect the fact that money got put back into bonds over the last few weeks. And 130 will be resistance, I think. So if it gets to that point in time, I probably will be shorting the TLTs. That's at least a good risk versus reward scenario for us to look at. Gold, another commodity, obviously had a big move last week or a week and a half ago. It's now hovering. I don't think it's going to regain that 170 level very, very easily. So I think shortable on rallies, but continues to stay range bound. And I think that's where we're at. Another actionary play this morning, ANF is up huge, above 40, which again, I think it's heavily short. I don't know the short interest. Possibly could try to attempt to fill that gap. We have 42.85 as the first level. If it gets into that gap, it's almost 45 is the next level. That might affect some other retailers, but I think the retail sales are a little weak. So we're in that stage right now, guys, where I am pretty much hands off. I'm waiting for an opportunity. I think less is more, and you get into that tape. We had a tremendously good run from August, September on the bullish side. Got a little bearish last month. And now we're just getting sideways action. That sideways action is the easiest action to get chopped up on. And as a trader, certainly as an experienced trader, you see it. There's times to really press the button and press the gas. There's times to really, quite frankly, put on the brakes. I think we're in that point where the less you do, the more successful, more profitable you are going to be. And that means waiting for your prices, waiting for your opportunities, having some conviction on your ideas, and following through with it. Less size right now is the key. No need to put on or position yourself accordingly. I don't think we're in that point. Understanding we've just come down, a decent amount. The oscillators right now are not at a point. You'd love to see it down 45. We'd love to find that bounce, but every time we're not getting this significant bounce. If we get back to 60, 65, maybe 70, that might show us, and we get a nice little reversal intraday. That might be our, the time that you can ring the bell. But until that point, we're just sitting in this range, and you got to respect it. Good luck trading today, and I'll see you on the floor.
Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.